Good morning, everyone, and thank you very much for joining me. This is the morning market review with myself, Russell Shulman, Senior Market Specialist at FXCM, and my email address arthur@fxcm.com. Today is Friday, and it's the 2nd of September, 2022. And of course, it's non-farm payroll Friday, so we'll have a live trade today, and I am pasting the link to that in the chat. So if you'd like to join us for that, please go ahead and register, and you're certainly most welcome. I'm just going to bring up the high risk investment warning. I'll keep this on screen for a few moments. I do have a meeting booked this morning, so we'll have to cut this this morning's webinar short, so I apologize for that, but we'll catch up again later in the day when we do the live trade. I'm just going to bring up a market commentaries disclaimer. I'll keep this on screen. Hey Sam, nice to have you on the webinar. Howard, Rob, pleasure to have you guys. Thanks very much for joining, and thank you everyone for joining this morning. Let's just bring up our references. I've changed it from CNBC to Bloomberg, just in terms of our sort of what we need to know for the morning. And just to let you know where I'm getting the information from in Bloomberg. So I get an email, and the email basically, I can't quite remember how I registered for it, but I'll just bring it across. This is my mailbox, and you can see I get this email, 5 things to start your day. So I'm just going to go through that with you guys. I would give you the link to register for it, but I can't find it. I'll get it. There's two. There's a European edition, and then sort of in the afternoon you get the American edition. So if you want to register for, try search for it. If you can't find it, let me know, and I'll try to see how I registered. But I think that the information here is probably a little bit more complete at this particular time. We'll use market scope. We'll look at trading views. So I'm going to put up trading view, and I think let's just go through the email. Oh, okay, cool. Sam's actually sent me the. Oh, brilliant. I'm going to share this with you guys. Hold on one sec. Here we go. I'll just share this with you guys. So, all right. This is from Sam. So just see what it's all about. I don't have a subscription to Bloomberg. I do have a subscription to Barron's, which also is Market Watch. But I'll just see, because Sam has also said there is a subscription special on now, but I'm not sure. I'm not quite sure what it's all about. I'll need to take a look at it. No, so my subscriptions for Barron's. I quite like their articles. All right, let me know if you guys have any luck with that. And here's another link from Sam. I'll pop this one in as well. Just have a gander there. Okay, cool. Thanks, Sam. That's brilliant. Thank you very much. Okay. No, this email should be for free. You should get this 5 things in the morning and in the afternoon for free. Okay, no worries, Rob. Yeah, that's fine. You'll pop in at any time, and if you don't make it, I'll put it on Telegram. Okay. All right, let's go through the. Let's just go through the article. So the first headline, behind the curve. The European Central Bank is behind the curve on tackling record Eurozone inflation, and will have to act more forcefully than earlier envisaged to wrest control of prices, according to a survey of economists. Despite a surprisingly big increase in interest rates in July, more than 2/3 of respondents say officials have acted too slowly in battling inflation that has just hit 9.1%. They now predict a higher endpoint for the cycle of hikes, reach more quickly, and including a 75 basis point step on September the 8th. Meanwhile, a planned emergency intervention in European power markets may lower prices, but won't protect the region's economy from the spillover effect of a historic energy crunch, according to the bloc's executive arm. Russia is crimping gas supplies as it continues its war in Ukraine. The next article, slumping bonds, and I think this is really important, this one. Global bonds slumped into their first bear market in a generation, hurt by rapid interest rate hikes in many economies to quell historically high inflation. Why I say I think it's important is because it's linked to yields. So everything comes right back to interest rates and yields, and bond prices are inverse to that. The Bloomberg Global Aggregate Total Return Index of government and investment-grade corporate bonds has fallen more than 20% below its 2021 peak, the biggest drawdown since its 1990 inception, and treasuries could succumb to more losses later Friday. And listen to the next few lines. When the US releases a keenly awaited jobs report. Now, this is very interesting, as a solid number will boost expectations of another large Federal Reserve rate increase. That could in turn roil assets like equities, given that the Fed's goal is to put a brake on economic activity to get price pressures under control. What that last 3 or 4 lines is basically saying is that any good news is effectively bad news, because it's going to just add fuel to the proverbial fire of rate hikes, right? So that's what we're going to be looking at in our live trade this afternoon. The next article, Biden versus Trump. President Joe Biden is seeking to stoke voters' outrage over the extremism of Donald Trump and his supporters ahead of November's midterm elections, even if the strategy risks exacerbating political tensions in the US. In a primetime address to the nation Thursday from Philadelphia's Independence Hall, Biden sharpened the criticism he's recently used to describe his predecessor and Trump supporters, declaring that equality and democracy are under assault from extremist Republicans. He implied that the only way to stop them was to vote against Republicans who support the former president. Before the Thursday speech, House Republican leader Kevin McCarthy delivered a rebuttal in which he accused the president, not Trump, of inflaming divisions. So I don't want to spend too much time on that. Obviously, politics is very personal, so we'll just leave that one alone. Inflation and war. The risk of civil unrest has sparked across the globe as developed nations and emerging markets alike grapple with spiraling inflation and upheaval exacerbated by Russia's invasion of Ukraine, according to a report. Of 198 countries tracked in the Civil Unrest Index, 101 show mounting risks in the third quarter of 2022. So that's quite something. That's the biggest increase since the ranking was developed in 2016. The potential for unrest is rising across Europe, which is bracing for a long winter of energy disruption because of the war in Ukraine, as well as the developing world, where price spikes on basic staples have triggered concerns on a global food crisis. The threat is set to grow over the coming months, researchers say. Just a couple of more things that we'll read out of this email, and then we're going to go on to the analysis. So it reads here, stocks are in something of a holding pattern before the critical US jobs report, while a dollar gauge is near a record high and a sign of investor caution. Other expected data include Germany's trade balance and Spain unemployment. The UK leadership ballot closes this evening. The Ambrosetti Forum kicks off in Italy. Emerging market asset manager Ashmore delivers earnings after flagging in July that its assets under management plunged to a 5-year low. And just one very last point in this email. It reads the headline, and finally, here's what Cormac is interested in this morning. And Cormac is a guy named Cormac Mullen, and he's the deputy managing editor in the markets team for Bloomberg News in Tokyo. And it reads, the yen slump is now its worst on record, and traders are still betting on at least modest further weakness in the embattled currency. That's going by peak to trough that's going by peak to trough declines in the yen since Japan introduced the floating rate system in 1973. The Japanese currency has lost over 46% of its value against the dollar from its 2011 high, a steeper drawdown than the 45% slump it experienced during the late 1990s Asian financial crisis. All right, so it's quite a comprehensive sort of news email. I think we'll sort of follow this for the next few webinars. If you guys prefer the CNBC one, we can of course go back to that. You just sort of let me know and we can take it from there. All right. Mia is just asking, yeah, so Mia, this is actually a changeover. We used to read from the CNBC articles, but they've shortened it quite a bit. So I've switched to the Bloomberg. Okay, it's just an email that I receive. Alrighty, let's get some analysis done here. Just cognizant of time, so let's start off with the real rate, okay, which is this top chart here. And you can see that this is the daily chart. The real rates are moving very strongly. Okay, they are in this what we call zone 1, which is the upper red, upper blue. That's your bullish area. If there's going to be any appreciation in any instrument, it should take place in zone 1, logically, right? So on the daily chart, it's moving in this northeasterly direction. The chart underneath it, that's the US dollar. Well, the US dollar is in zone 1 as well. And you can see that it's moving in this northeasterly direction. This is one of my favorite sort of ways to look at the market, the correlation coefficient, and it's a very strong 0.8. And if we go up to the weekly chart here, okay, you can see that the correlation coefficient is very strong between rates and the dollar. So what does that infer? So if we had to make an inference from this, it leads us straight to the non-farm payroll today. And depending what type of release, what type of prints we get, I think that it's going to reflect in rates. So if we get a jobs number that beats forecasts, I would expect the dollar to really gain traction. Why? Because the speech at Jackson Hole was very specific in saying that there is an imbalance in the job market. So that's something to keep an eye on. And the interesting part of this chart for me was, of course, just the first 2 or 3 days of this week. There was hardly any movement in real rates. Then comes Wednesday, so it's the third day, and really sort of later on Wednesday we get a push up, and it's really been strong since then. So I was quite surprised that the rates hadn't moved after Jackson Hole, and then, well, you know, that kind of shut me up pretty quickly because the rates have actually responded quite firmly. And yesterday, I don't know if you guys were watching the market yesterday, but it was absolutely let me bring up a chart, you'll see. It was absolutely a bloodbath, so to speak, if you were long euro. So this is the chart. Here's the capitulation in euro, and we wrote an article earlier in the day that parity was under threat, and these are the line studies from the article, and the article kind of had data up until this point, And then just sort of an hour or two later, it actually capitulated. And if I put in the pivots for yesterday, it's very interesting. Just put in the historical pivots here, and you can see it goes all the way down to the S2, and S2 serves as support. And I was watching this very, very carefully. It just this particular price spike down was ruthless on the way down. It was right near the end of the day, by the way, sort of between 4 and 5. So that was a very, very interesting price decline. It wasn't isolated to the euro. Pound was hammered as well, but I was particularly interested in euro. I did have a position on here, so I was very interested here. You can see if we take a look at the daily chart here, we've got a breakdown. Again, we wrote about this in an article a couple of weeks back. Actually, we saw the ascending wedge. It broke down. It looks like we're getting some sort of pennant pattern here. So in classical technical analysis, pennant is a continuation pattern. So and of course it would have a measured move. But let's not talk about the measured move. It would suggest further downside in euro here if we break down. So the pattern's forming. It hasn't completed. A pattern doesn't complete until there's a breakdown, right? So we kind of in this pennant pattern. We can go through to our zone analysis. This is the daily. We're in the zone 3. Okay. Look at the momentum. Momentum's now in that lower quintile. So now we've got a very interesting setup here, because non-farm payroll here can act as a potential catalyst. However, and this is the big deal, if the non-farm payroll comes in a lot weaker than expected, well, then what's going to happen? And that's a huge question mark, because then it would be suggesting that maybe, you know, the labor market is slowing down, which is what the Fed wants to see, and that may actually provide some sort of support for the euro. I'm not certain, but it's going to make a very complex non-farm payroll trade if there is a weak non-farm payroll print. If you go back to last non-farm payroll, it came in a lot stronger than expected. What's interesting is the initial jobless claims is starting to moderate. Find that interesting. The continuing, this is where it gets really interesting, right? Initial jobless claims, initial jobless claims, okay, moderating. Continuing jobless claims ticked up a bit. Continuing jobless claims ticked up a bit. What's that telling us? People that have been previously laid off, finding it difficult to come back into the job market, maybe, but the layoffs seem to have slowed down. So let's keep an eye on that. Euro US dollar is bearish. Well, I can only give you my opinion. My opinion is it's bearish. Why is it bearish? Well, we've got 3 zones here. Okay, and the zones are measured by the upper red, upper blue, lower blue, lower red. The lower zone, what we call zone 3, that's the bearish zone. So if there's going to be a movement down, it generally is going to be in zone 3. Well, it has to be in zone 3 if there's a trend. If I make this through, if I show you the US dollar basket, it will be in zone 1, completely the opposite. Okay, completely the opposite. And then what's really instructive about using the zones is you can use it for relative type of analysis. For example, the movement from zone 3 into zone 2, well, that's relative strength, right? Then the movement from zone 2 into zone 1, well, that's relative strength. Okay, so you can kind of measure the positions. Now, also what's cool about this is you can take a look at it on a longer term basis. So let's go through to DAX now. And just have a quick discussion about DAX. So you can see DAX here is in the bearish zone, isn't it? Okay, it's in the bearish zone. This is looking quite messy. Let's just take out the historical pivots. All right, and let's take this out. And what we can keep an eye out for, if the daily is in zone 3, and if we get some sort of decline in the hourly conditions, so in other words, if the EMAs cross down, if the stochastic crosses down, well, that's the shorter term traders perhaps starting to sync up with the longer term trends. And again, just based on this relative analysis, okay, we're looking at the daily now. You want to take a look at what's happening sort of on a grand scale, what's happening in terms of the real primary trend. Just take up the monthly here, right? And here you can see where the danger comes in, because now we really a bird's eye view out. So what's happening here? Well, we're in zone 3. It's not utter destruction on the monthly chart, but it's getting to a point where there is a distinct possibility of real destruction in terms of equities. And you can see that the momentum is getting to that lower quintile. This is not, I want to stress, there's no such thing as oversold on a stochastic. There's no such thing as an oversold condition, okay? It's either going to stay in the 20. If it stays in the 20, that's bad news. Well, it's going to dip out of the 20, okay? If it gets down into 20 and stays, and then as Anna points out, what's happening here? Okay, volatility ticking up. So there is a real capitulation in the longer term chart. Now let's just link this with some fundamentals, and then we'll end off here, and then we'll come back for the live trade. So yeah, okay, it's all good and well to say technically we can see that we're declining here. Okay, it's all really good, but we've got to ask why. You know, what's the reason that we are showing inherent weakness here? And we've been stressing the time value of money, right? So if you take a look at interest rates are moving up, and what we'll do is we'll switch this to the DAX. I beg your pardon, to the Bund. So let's just bring in the German 10-year. Okay, we'll bring that in. All right, so you can see that the Bund here, and this is your nominal rate, right? Because it's including your inflation adjustment. That's fine. So this is exactly what you want, and it's moving up. So if interest rates are moving up, mathematically, it's going to put pressure on your present value. I want to just run through the formula. We're not going to get too involved with it, but this is from yesterday. And what is happening on the DAX is your total rate here is starting to increase. Okay, your total rate here, because of your nominal rate, that's starting to push up. But if that's starting to push up, present values must be coming down. So that's just your time value of money mathematics. We can go deeper than that. What about companies that are carrying debt on their balance sheets, and now interest rates are moving up? Well, that's going to flow straight into income statement, your profit and loss statement, because you have to pay interest on that. Well, your interest payments are going up. But if your interest payments are going up, okay, that's going to affect your bottom line, must affect your bottom line. There is an interesting phenomenon with regards to interest payments. It could give some sort of, I guess, tax benefit, what they call a tax shield. But by and large, it's going to push your bottom line down. But we can go deeper than that. Okay, so not only are not only are debt payments going to be hurting the income statement, what about the customers of companies now? So the customers may be paying using some sort of credit or some sort of borrowings, right? Well, now those are going to come under pressure. So that's going to push down demand. Well, it's going to push down demand. Where's that going to hit on the income statement? It's going to hit the top line. It's going to hit your sales, your turnover. So now you're getting hit on your turnover. You're getting hit on your interest payment line item. You're getting hit on your time value of money calculation. And effectively, that is what we are seeing reflected in the technicals. So I think that is probably where it's a good place to stop. Again, just cognizant of the time. I've got just begging your pardon, but got a morning meeting. If there's any questions, please go ahead and type those in. Any questions, please go ahead, type those in. All right, good. Let's wrap up here, guys. I'll get this up on Telegram and looking forward to doing a live trade on a live account with you guys later this afternoon. Thanks, guys. You too, Rob. You too.